Welcome back, everybody. Let's get started. Last class. So today we're going to be talking about pitching first, not baseball, not relative to the playoffs coming up, but no, pitching, the process banks use to sell their services to prospective customers. And then we'll talk about this for probably about an hour. After that, we'll take a quick break, come back, we'll talk about interviewing, recruiting, all that. So if you have questions on recruiting, that would be a good time. As part of that discussion, we'll also be reviewing a lot of the key technical concepts of the class. Banking interviews tend to have a lot of technical interview questions, things like how do you calculate enterprise value. So we'll go through a lot of those items in the context of our recruiting discussion. So that's the roadmap. Today's the last day, as we all know. Again, if you ever need to come back, you always are welcome to. I think I've made that clear a couple times, but feel free, just let me know, let the guys in New York know that you're going to come back, and you can always come. All right, so let's talk about pitching. Like I said before, pitching is the process banks use to go out, offer their services to prospective clients. This is the selling process. This is the marketing process. And most of the time, if you work in an investment bank, if you're an analyst, if you're an associate, you can spend half, sometimes even more than half of your time pitching, the other half of your time on live deals. So today we're going to talk about all the things that go into the pitch process. We'll talk about pitch books. We'll talk about what's contained in pitch books. We'll talk about the analyst and associate's role in that process. But anytime a bank is looking to win business, whether it's to go out and manage an IPO for a company or raise additional capital in the public markets or in the private markets, if they're trying to win business for advisory services like M&A, that type of thing, restructuring, real big right now. Or even if banks are pitching for financial opinions business, that is issuing valuation opinions, issuing fairness opinions, that type of thing, there'll be typically a pitch process associated with that, where the bank goes into the client, tells them all about themselves, tells them about what they think valuation might be, et cetera. And just like any other business, obviously, we've got to win business in banking. We've got to keep the doors open. We've got to pay bonuses, all that. So again, you might spend up to maybe more than half of your time pitching. It's a very important part of banking. Sometimes not the most glamorous part of banking, but an important part nonetheless. All right? And I think I've mentioned before, but banking is a relationship business, just like a lot of other businesses, legal business, et cetera. Banking is a relationship business. And when we talk about a managing director, basically the biggest value he or she brings to the table is their Rolodex, whom they know, how many doors they can open, how much business they can bring to the investment bank. Managing director is largely a rainmaking or marketing role geared at bringing in new clients. All right, so that's what people ultimately aspire to in banking. Managing directors that bring in a lot of business are obviously making a lot of money. They can make 7, 8 figures a year in good years. Right? Not at all uncommon. All right, so a lot of business, as we mentioned, relationship business, a lot of business driven by referrals, past clients. The boutique bank I used to work for a number of years ago in Philadelphia, we got almost all of our business from existing and past clients. We would do just all their investment banking work for them year after year after year. We'd get a lot of referrals from attorneys, especially when attorneys were out soliciting investment banks to write fairness opinions, to write valuation opinions. A lot of that would come to us through that referral channel as well. So managing directors who have spent years and years developing relationships in industry with CEOs, CFOs, boards of directors, et cetera, developing relationships with past clients, lawyers, accountants, et cetera. A lot of business can come in that referral route as well. And a lot of times, especially when banks are working with maybe clients that maybe are a little less sophisticated or maybe a little less in tune with what's going on in the capital markets, banks may actually be proactive in pushing particular transactions. All right, telling CEOs, telling CFOs it might be a good time to think about consolidating. Here are some ideas that we have regarding M&A. Here are some ideas we have regarding some alternatives, et cetera. And a lot of times, as part of the pitching process, analysts and associates will, rather than just putting together pitch books, we'll spend a lot of time researching industries, understanding the dynamics in those industries, understanding whether an industry might be ripe for consolidation, and basically getting all the materials together to be able to help recommend particular transactions to clients. Like we say here, a lot of CEOs are so focused on their business, they're not so focused on what's going on in the capital markets. And this is another place where investment banks can add a lot of value. Now, when we say bake-off, a bake-off is a term to refer to the process where multiple banks come in to a client and pitch their products and services. Bake-off, dog and pony show, whatever you want to call it. That's, again, where banks get the opportunity to come in and pitch, tell the client why they're the best for the job, et cetera. Banks are often invited, one by one. So they'll come in, Goldman Sachs will come in, then Morgan Stanley will come in, then JP Morgan Chase, et cetera. Come in one by one, present, not just what they think the company might be valued at in a particular deal, but also, very importantly, as we'll get to in a moment, talk about the bank itself, why they've got more experience in a particular industry or a particular product type, et cetera. All right, these are, basically this is the culmination of a lot of work by analysts and associates putting these materials together, finally getting in front of the client, pitching and trying to win the business. It can be a very, very stressful process. You can spend weeks and weeks researching an industry, putting together pitch books, running valuation models, et cetera, only to walk away empty-handed. So this is really an important and can often be a very stressful process. It can also be multiple rounds. All right, not at all unheard of for very large deals. The prospective client might bring in 10 or 15 investment banks. For the first round, cut 5 or 6 of them out, go to a second round, maybe make another cut, go to a third round, like a golf tournament, right? But at the end of the day, that can add to the stress of this process. It gets really tough to kind of think of new things to say at each successive round. So it can be pretty challenging in that respect. All right, but we'll talk a little more about that. We'll talk, obviously, a lot about what goes into these pitch books and the pitch process as well. So when we talk about the pitch book itself, we're talking about the spiral-bound material that gets put in front of a client. And like I said, Ernest brought in a couple pitch books. One was a Merrill pitch book. Another was JP Morgan. He's got a third. So he's going to pass some of those around. I took a look at them. There's some good examples of a typical pitch book, about that thick. Contains a lot of the things we're going to talk about here. Most pitch books, as a table of contents, are going to have something similar to this. We're going to go through each one of these individually, talk about what's contained in each section, but introduction to the bank, qualifications. Usually there'll be an industry overview, a market update, that is what's going on in the capital markets. Talk about the company's specific situation as it's been explained to the bank. Talk about valuation. Obviously, we've spent a lot of time in valuation. It's always an important focal point of any discussion regarding a deal. Oftentimes, they'll talk about the sale or the financing process. If it's an M&A deal, we could have a roadmap or a process timeline very similar to what we talked about yesterday. Here are all the things we're going to do in M&A. And then finally, there'll typically be a buyer or an investor list somewhere in there. So the intro and qualification section, this is always first in the pitch book. This is talking about things like why we're here, right? If we're Goldman Sachs, why are we here today? And most importantly, who are we? What is the team? And what is our expertise in this particular transaction or this particular industry? What deals have we done in, say, the pharmaceutical industry that would qualify us better than any other bank to do this pharmaceutical deal that we're talking about? All right. So this can be one of the very most important aspects of the pitch book. A bank's qualifications alone, managing directors' relationships in a particular industry alone might be enough for them to win the business. All right. So they'll talk about, when we talk about the particular transaction or the particular industry, they'll talk about deals that they've done. All right. If it's M&A, they'll talk about M&A deals. If it's the pharmaceutical industry, they'll talk about M&A deals in the pharmaceutical industry. Okay, if it's a European deal, they'll talk about their experience during doing deals in Europe. All right. They'll also reference something called league tables. Anybody know what a league table is? They're basically rankings of the investment banks. Who's done the most transactions? Who's done the most transactions in the United States for M&A? Who's done the most for IPOs? Who's been active in Europe? Who's been active in South America? Who's been active in particular industries? There are a number of different league tables out there, And what banks do in this pitch process is typically slice and dice the data to make sure that they're presenting the league table that shows them toward the top. All right, so if it's a European pharmaceutical deal for M&A, it might be a situation where the first bank comes in and says, we're number one in M&A, just period. The next bank might come in and say, well, we're number one in doing pharmaceutical M&A. And then the third bank would come in and say, well, we're number one doing European M&A and pharmaceuticals, all right, that type of thing. So again, banks are slicing and dicing those league tables to present themselves most favorably to the client. Banks might also present tombstones or case studies of deals they've worked on. Again, we talked about tombstones yesterday. There are a couple going around as well. But this precedence in doing deals in a particular industry or having done deals in a particular transaction type can't be understated in terms of their importance. Like I said, a lot of times this is a key reason why banks will win or potentially lose business. Next, or shortly thereafter, there'll typically be an industry overview, basically talking about, number one, the bank's knowledge of a particular space. All right. Again, getting back to how many deals we've done in M&A, in pharmaceuticals, for example. All right. If we're talking about an industry where there are boutique investment banks specifically focused on that industry, you can think of Thomas Weisel in technology. You can think of Allen and Company in media, et cetera. All right. They're going to be obviously very focused on their expertise. They're going to be the ones that typically will be shortlisted for any bake-off involving technology or media, et cetera. All right, and for certain industries, especially tech, especially financial institutions, this is really a very important factor that the bank understands these industries. There are different dynamics in different industries that drive valuation, drive transaction dynamics in industries. The bank needs to be able to understand those. If a bank has never done a technology deal, it's going to be tough for them to come in and say that we're going to be the right bank for the deal here. Chances are the company's going to consider a bank with more technology experience. Right, this is also a section where we talk about what's going on in the industry. What is our understanding of the dynamics here? Okay, if you look at the food industry or the confection industry, we've talked about that Kraft Cadbury deal that's in the news a lot lately. And if we're talking about another food deal, we're probably going to reference, here's the Kraft Cadbury deal, here's what's going on there, here's what we see in terms of ultimately what valuation is going to look like there, what it might mean for your company in the M&A context, et cetera. But at the end of the day, we're asking and hopefully answering the question, is it the right time to be seeking funding, taking the company public, or doing a transaction in this industry? All right, and you can probably imagine that the right answer is not always yes. You can think back to what's happened over the last year in the marketplace. Really hasn't been a good time to do transactions in any industry. Right. Market overview section. Again, this is going to be somewhere around where the industry overview section is. This is really where the banker talks about their understanding of what's going on in the capital markets, what's going on with respect to a particular product that we're talking about. So what's happening with M&A? What's happening with IPOs? What's happening with restructuring? Okay, so this is a good time to sell, or maybe let's hold off on an IPO. Probably it's more the latter these days. Let's hold off on that IPO windows. The IPO quote-unquote window right now is starting to open, but probably not the most favorable or receptive environment for new issuance at this point. And obviously, if we've seen where valuation has gone in the last year, timing on particular transactions can be very important as well. All right, so if you go out in a bad M&A environment, it's not at all unusual to see company valuations plunge. Certainly in the last year, we've seen valuation plunge by 50%, recover somewhat, but valuations in certain industries are still pretty down and out, especially those that are really sensitive to the overall economy. Company and situation overview. This is where the banker is demonstrating that they understand what's going on with the company, they understand the situation right now, and that they're going to be able to accomplish the goals of management, the board of directors, really whoever's driving that particular transaction on the company side. And this is really important for boards of directors, management. They need to understand that banks see eye to eye with them. and they want to see exactly how well or maybe how poorly the banker might position whatever the product offering is to the market. All right? Whether it's an IPO positioning or a pitch for an IPO business, whether it's a pitch for M&A, this is where the banker is going to demonstrate their ability to market the offering to the public or to the buyer pool. And a lot of times, if we're an investment bank, we might not get a whole lot of information going into the pitch. If it's a public company, obviously there's a lot of information. We can go to the SEC website, download all the 10Ks, 10Qs, 8Ks, etc. But if we're talking about a private company, we may be very, very limited in terms of the amount of information given to us prior to the pitch. They may only give us financial statements. They may only give us enough so that we can get a rough opinion of valuation, but they may purposely withhold sensitive information at this point in the process. One, because it's sensitive, all right, and two, because maybe they want to test how creative we can be in demonstrating our understanding of the company. So, like we say here, some bake-offs will purposely limit the amount of information distributed to all the banks, and it's up to the banks to get a little more creative in their pitch to demonstrate their knowledge. As we talked about before, valuation is always a focal point of any discussion, especially a pitch. A lot of times when you pass out the pitch books, you see the board or management, whoever's the audience, immediately flipping to valuation because they just want to see what do the numbers look like. Is this bank coming in around where we expect valuation to come in? And typically this is, especially at this early stage, we're not giving specific numbers. We're not coming in saying valuation is, $5.25 billion. Rather, we would say valuation probably $4.75 to $5.5 billion, somewhere in there. All right, and then that range again would get tightened up as we go through the process, as we learn more information, have a chance to digest that and incorporate that into our analysis. All right. A lot of times, as we've talked about before, pitches are going to rely heavily on what's going on in the market, so comparable companies or trading multiples analyses, precedent transactions, to the extent we have them. And obviously, if we're talking about a potential deal that would involve a controlling interest, we'd want to be speaking in terms of controlling interest. If we're talking about IPO, where it's a minority interest stake being sold, we'd want to talk in terms of minority interest valuations. And that's why we discuss those in the valuation section. DCF, we're always going to do a DCF. We're always going to do it, but a lot of times, as I talked about before, we may not rely upon that as heavily as we would trading multiples or precedent transactions. All right. But it's unusual for a banker to walk into a pitch blind in terms of what the valuation expectation is. Typically what happens is when the MD initially gets that call, to be part of the bake-off, usually the question will be asked at some point, or should be asked at some point, well, Mr. CFO, Mr. CEO, where do you think valuation is coming out? What is the expectation of the board? Because the last thing we want to do is spend weeks and weeks and weeks doing valuation, doing all kinds of analyses, and come in 50% of where the company expects it to be. All right? Obviously, that's a non-starter. All right? So typically, that's what's going to happen. In this process. Again, we'll rarely walk in blind to a pitch in terms of what valuation should be. All right. Any questions on valuation and its use in the pitch context? And this is where we need to also be a little bit careful, and I touched on this yesterday. Going in with a really aggressive pitch valuation might allow us to win the business, particularly maybe from an unsuspecting board or management team. They haven't gone through this process before. They see one bank that's way above all the others in valuation. They might take the bait and go for that. Well, at the end of the day, though, the investment bank kind of needs to deliver on that number. And that's where we said yesterday, that's where aggressive pitch valuations can be problematic. If we get 3-4 months into the engagement, and all of a sudden valuation is half of what we said in the pitch, again, that's an extreme example, but if we're materially different than what we pitched the company on, it's obviously going to cause some problems. Right? So typically what happens in these situations is all the investment banks come in, they all have an understanding of where the company expects valuation to fall out. Let's say it's $500 million. typically what banks will do is they'll all come in slightly above that. All right, enough above that where it wouldn't be so bad to back off on that if they were to win the business, but not too far above it where they're an outlier. All right, so if they come in at, say, 550 million, 525 million, maybe 5 or 10% above, that's pretty acceptable. If they come in at $1 billion, or if they come in way low, obviously those can be non-starters, all right? Or if they're way high, it can be problematic down the road. Does that make sense? And that's where a lot of times analysts, associates, as I mentioned way back when we talked about valuation, that's where valuation numbers need to get managed, quote unquote managed. Right? Like I said, it's rare for an analyst or an associate to start a valuation exercise without knowing where they need to come out. And a lot of times our selection of multiples, our selection of discount rates, our usage of things like company-specific risk premium, those items, that's what will influence those, is so we can get to the range of numbers we need to ultimately put in front of a client. Makes sense? Like I said earlier, we'll also at some point be talking about the process. Right? So if it's an M&A sale assignment, we'd want to be talking about how, what those first couple weeks, couple months might look like in terms of gathering materials, putting together our CIM, putting together our teasers. We'll talk about how we're going to reach out to potential buyers, whether we're going to go out as part of an auction process or maybe it's a little more of a controlled sale, that type of thing. We'll talk about how long we expect each step in the process to take. We'll talk about how long we expect the overall process to take as well. Really, ideally, give the company a good idea, a good roadmap of what to expect if we were to be hired, what steps we're going to take, how long it's going to take, and obviously, just like with valuation, if we're goosing the numbers a little bit, we're probably going to show an accelerated timeline as well, because like we said yesterday, speed can oftentimes trump valuation. Companies, when they get into this process, they want to know that the deal can get done reasonably quickly so that the market doesn't fall out from under them. There also, at some point, will be a discussion of who the bank would expect to be buyers or investors for a particular offering. And again, this is another opportunity for the banker to demonstrate their knowledge of the space, understand within the pharmaceutical industry, for example, who is particularly acquisitive, who's got the capability to do deals right now, who might have just done a large deal and is still digesting or integrating that, and maybe they're not going to be the best group to approach for the transaction. Right? So it's a great way to show our knowledge of the space. It's also a great way to miss something and create a problem for ourselves. All right? So typically we're creating very, very extensive lists. We're throwing in everything except everything but the kitchen sink, so to speak, in terms of our list of potential buyers. The last thing we don't want to do is miss an obvious buyer. And I've seen this presented a number of ways. A lot of times I've seen it presented in the form of a matrix where basically we're giving, for each buyer, we're giving a description of their business. We're talking about strategic buyers here, competitors, folks in the industry or related industries. So description of their business, where they're located, what their financials look like, and especially what's their liquidity right now. So do they have a lot of cash? Do they have a lot of availability under their bank facilities to finance an acquisition? Is their stock price at a level where it would be feasible for them to use that as currency in the deal? All right? So the higher the stock price, the less stock they have to issue, the less dilutive the deal is, like we talked about yesterday. So that might be one way to gauge capability of one of these buyers to close a transaction. Really important strategic rationale, fit. Think back to the Microsoft Yahoo discussions, the M&A discussions, say a year ago or so. Really a tough deal from a strategic and cultural fit perspective. The Yahoo folks really were against that deal. They probably would have lost a lot of their employees had that deal ever closed. There's obviously an issue with valuation as well, but strategic rationale and fit are very important. It's important that the banker can demonstrate their knowledge of what deals might work, what deals might not. All right. Details of recent acquisitions goes back to the knowledge of the space. Who's busy acquiring, who's been traditionally acquisitive, who is not. will give us an idea of what the most likely buyers could be. And then very importantly, perhaps even most importantly, who does the banker know in that space? Right? Do they, perhaps play golf every Saturday with the CEO of the most likely buyer? Like we said earlier, banking is a relationship business. That alone might be enough for Goldman or Morgan Stanley or whoever to win the business. The fact that they can immediately pick up the phone, call the most likely buyer, and quickly broker a transaction. Again, that was for strategic buyers. We'd probably also give some information for financial buyers if it was a situation where it could be a leveraged buyout, all right, or even if it's an IPO, who might be some of the large institutional buyers for the shares, all right, and what relationships might we have with them? All right, so what type of fund might this group be? Is it a venture fund investing in early stage situations, or a buyout firm? Maybe it's a turnaround firm investing in more of restructuring or distress situations. Where are they located? That can be important in the buyout or even the venture industry. A lot of times buyout funds don't want to do deals that are more than, say, a 2-hour plane ride away. They want to be close. They want to be able to manage those portfolio investments closely, and they don't want to be investing in Boston if they're based in Newport Beach or something like that. Right, so that can be important. How big are they? What's their AUM, their assets under management? Real importantly, what is their fund availability? Okay, maybe they're fully invested on their last fund. If you think of the situation right now in private equity, it's a very difficult fundraising climate. So if a private equity firm has to go back to the market and raise additional funds in order to be able to do a deal, it might make them a long shot in the process. So that can be very important. Average investment size, that can also be very important as well. Groups like Blackstone, like I think I alluded to a few weeks ago, Blackstone's latest fund, which a year or two ago I think, was $20 billion. So when they go into a deal, they're not investing that in little $10 million pieces. They'd never get their fund fully invested. So certain deals, by virtue of their size, may preclude certain financial buyers from wanting to be a part of those. Right? Private equity firms, like I said before, they're motivated to get their fund fully invested, get back to the marketplace as quickly as they can, raise ever bigger funds, because those management fees, that revenue stream from the management fees gets bigger and bigger. So they don't want to be making small transactions, small investments at a time. Targeted industries, should go without saying. Certain funds might only want to look at industries with which they have a particular expertise, particular knowledge. Financial requirements. You see this a lot in the middle market and lower middle market funds, that they want to invest in companies that have, say, EBITDA between 2 and 10 million, or EBITDA from 10 to 50 million, or something like that. They're really going to target companies of a particular size because at particular EBITDA levels, and the application of multiples to that would imply transaction sizes that fit their needs. And then overall investment thesis. What do they hope to accomplish? How long do they want to hold their investments? What type of returns are they looking to achieve? Maybe it might be a 20% IRR with, say, a 2.5 times on cash invested within a 3 to 5 year period, or something like that. But it would be presented very similarly to how we present our list of strategic buyers. All right, so again, pitching, very, very important. You can spend half or more of your time in these marketing roles if you're an analyst or an associate. And if you're an MD, MDs are spending pretty much all their time bringing in new business, networking with former clients, networking with new clients, trying to get banks invited to those bake-offs so they can be a part of the process. Like we said, banking is a relationship business, very, very important, as is a bank's reputation for doing a particular transaction type. Think of Lazard and M&A, all right? Bank's specific industry and product expertise, very important as well. Right? Valuation, again, always a big role in the process, but can be dangerous. Banks that go too high on valuation may have to later backpedal and create a big political problem with the clients. Some engagements might be determined by fees. That's typical, really more of smaller transactions. middle market, lower middle market deals. You don't see that so much in large transactions. Fees are pretty standard. Generally speaking, sell-side M&A is probably going to be about 1%. If you're on the buy side, it's probably going to be roughly half of that. Maybe 1 to 1.5 on the sell side, still roughly half of that on the buy side. All right. And then finally, the practice of pitching research no longer allowed. What do we mean by that? I think I alluded to that in class 1, but what do we mean by the practice of pitching research? It became really prevalent back in the tech heyday of the late 90s, early 2000s. Tech bankers, if they were going in pitching to win IPO business, they might bring a research analyst in tow with them and say, if you give us the business, we're going to cover your stock favorably for the next 3 years or so. We're going to keep a buy rating on your stock. All right, CEOs, boards of directors, compensated based on stock price. Obviously, that can be valuable to them. Obviously, there's a major conflict of interest there as well. So that was eliminated several years ago now. The practice of pitching research, strictly forbidden. It's part of that Chinese wall discussion that we had in class 1 and why the banking side of the house might be separate from the research side of the house in a bulge bracket firm. All right, well, that's all we have on pitching.